Hola, welcome to Basics Simplified. So today we are going to be learning yet another monetary policy tool, which is Statutory Liquidity Ratio (SLR). This is sort of similar to cash reserve ratio, which we learned in the last video, but also has a bit of dissimilarities. Okay, similar to cash reserve ratio, SLR is based on a percentage of the bank's NTDL, which is net time and demand liabilities. Let's recollect. What is NTDL? So FD and RD kind of time targeted savings or time targeted payments that the bank have to make come under time liabilities. Then what would demand liabilities be? Savings account, current account and demand draft. Okay, anything which the bank has to pay on demand, whereas time is anything which the bank has to pay on a specific time frame. Okay, so combination of all of this gives you NTDL, net time and demand liabilities, also known as total deposits of a bank. Okay, so SLR would be a percentage of the total deposits of a bank. So right now, as in June 2020, SLR is 18% of NTDL, which means the banks have to keep 18% of the total deposits separate for safety purposes. Okay, your question would be, aren't we already doing that with CRR, where the banks have to do it for 4% or 3% or whatever? True. The thing is, SLR is supposed to be liquid as well as give a bit of income back to the bank. Okay, so how would you save SLR? It's called as liquidity, right? So you can do it in three ways. The first one is cash, the second one is gold, and the third one is government securities. So what comes under government securities? You could say government bonds and treasury bills. Okay, so banks can keep SLR in either cash, in either gold, or in government bonds and treasury bills. Okay, now when you look at this, you would be asking the question, would the banks maintain SLR with themselves or the RBI? They maintain SLR specifically and only with themselves. They do not give it to RBI for safekeeping, like how they do it in cash reserve ratio. Okay, so now I told you like there are differences between SLR and CRR. So what is one major difference? Remember when I told you CRR doesn't give any interest returns? So whatever money is maintained as CRR does not get any returns, but SLR does. You do get interest. Okay, how do you get interest? Through government bonds or treasury bills. By buying a government bond for keeping as part of SLR, the banks earn an interest from the government bonds. So most banks try to keep most part of their SLR requirement as government bonds, so that even though they are not lending it out, they are still earning a considerable amount of interest. Got it? Okay. Now let's look at how SLR actually affects banks and the common folk. So let's say the total NTDL, the total deposits is $30 million. Cool. Now SLR currently is, we would assume SLR as 15%. It's not 15, it's 18, but for easy math, let's assume it as 15%. Okay. So out of 30 mil, you have to have this separated into two components. The first component is what you maintain as SLR, which you're not supposed to lend out. It's a liquidity requirement for safety purposes. And the other remaining part is what you lend out. Okay, so out of 30 mil, you would be saving up around, you could say 4.5 million. Okay, 15% comes around to 4.5 million, which you would be saving for SLR. Fine. The remaining 25.5 million is what banks use for lending purposes. So out of the total money, this is locked out, while this they use for lending purposes. If the banks don't fulfill their SLR requirement, they have to pay a fine. Okay, so that is the major reason why banks always try to keep SLR in check. Fine. Now what happens when, similar to all the other things we learned, CRR, repo rate and everything, what happens when SLR is increased? When SLR is increased, so from 15%, let's assume SLR went to 20%. Okay, so 30 mil remains the same. This doesn't get affected, but this parts get. So what is 20%? It is 6 mil. Okay, so what would be the remaining amount that they can spend? It becomes 24 mil. Okay, and what does this mean? When SLR is increased, banks have lesser money to spend. So when there are lesser money to spend, how does this affect common folk? Lesser the money, more the interest, right? Which means that people borrow less because interest is higher and the amount of money left is less. Okay, so how about when interest rate, that is SLR, is reduced? So from 15%, what if SLR becomes 10%? So this becomes 3 million, right? So how much does bank have remaining for spending? 27 million. Cool. 30 minus 3 is 27 million. So when the bank has 27 million, which means it has more money, it leads to reduction in interest rates for lending purposes. Okay. So based on this way, the MPC can use SLR just like the same way it uses CRR. It can increase SLR to tackle inflation and can decrease SLR to cause inflation. Got it? And that's what SLR is. Hope you understood it. Have a good day.